We're overweight equities, as you said, and we actually think, post the election, we think a lot of uncertainty will be removed from the market. So we're actually looking between now and year end for a good market. But more importantly, we actually think we're going to have a good year next year. I think, the market will probably like some gridlock next year. So we're positive on the year end, but we're positive on next year. And a lot of the activity in Washington we think will help.
What uncertainty has been removed since Tuesday, other than the fact that we know now that the Democrats will hold the House and the Republicans the Senate?
Well, there was a wide divergence in policy. I mean, President Trump was talking about an additional 10% tax cut. The Democrats had many policies. The repeal of the ACA, the Affordable Care Act, we think is now off the table. So that uncertainty with regard to healthcare stocks is out of the way. The further fiscal stimulus, if we did get that additional 10% tax cut, that could have put more pressure on the Fed. So you'll see less pressure on the Fed, which we think will be a positive for next year.
Less pressure on the Fed. We got that hot PPI number this morning, Bill Stone. What does it tell you that whenever we have sharp sell-offs, it seems like technology bears the brunt of the losses? Does that signal something about how the markets, how investors are seeing economic growth going forward, seeing leadership in this market?
It could be some of it. So I think you're right in terms of technology. At the moment, anyway, is lumped in with a lot of the other cyclicals. But I think technology, even in and of itself, it's been on, multi-year tear higher. So I think some of that is a bit of the fact that they got, in general, pretty expensive relative to some other places. So I think they are suffering a little bit more. But, when you lump it together, it's a lot of the more economically sensitive sectors that have, borne the brunt of some of these turn downs.
What do you see in terms of growth for next year, Bill? And I ask you that because, as I mentioned, we got that hotter than expected PPI number. In part, this market reaction is the thinking that the Fed is, perhaps more cemented to its path of rate hikes in the face of what could be slowing economic growth.
Yeah, and I think, obviously, I think most of us, and certainly the market's pricing in a Fed hike here in December. We still think, yes, the global economy and the U.S. economy are, I'll say, slowing down a bit. But at the end of the day, we really don't think that you need to be fearful of a significant downturn, which is why we'd say, you probably should stay a little more allocated towards some of the more cyclical areas. And I think that's probably a place to look. And I think mixed up in there, of course, is the oil weakness today. Some of that could be the economic side. I think most people think it's supply, not really the some sort of economic weakness. But you never know for sure until it's done being weak.